Hi, welcome back. Today we're going to talk about Treasury securities and markets. This is Chapter 4 of our Introduction to Real Estate Finance set of outline chapters. Okay, so I want to begin with just sort of putting into context where we've been in this course and where we're going. We started out with an introduction showing how finance helps real estate professionals. Then we looked at, as you hopefully will recall, some issues about real estate capital markets, who participates, what are sources and uses of funds, what entity types there are, what types of financial instruments there are, that type of thing. Then we went into part one of our design build financing framework, and we did that through the prism of the feasibility study. First step, quick and dirty, is this possibly going to work? And then we realized to do better, we needed to learn about the time value of money. So we did that, future value, present value, interest rate, discount rate, all that kind of stuff, up to and including internal rate of return, part one. And then that enabled us to bounce back to our design, build, or development type of projects and to look at those in a financial plan framework where we had a sponsor, equity investor, and also a lender. And now we're applying time value of money to understand the potential viability of a project for either a lender or an equity investor, i.e. sponsor, etc. Okay, and we need to go actually even farther. One thing that we haven't spent nearly enough time on is financial risk. We've talked about it a little bit in things like making sure we do different scenarios, thinking about what could go wrong and that sort of thing. But we need to be a little more rigorous about that, and that's going to enable us to use additional, more sophisticated discounted cash flow methods, such as NPV, etc. So we're going to spend this chapter on this sixth item here. And once we get through that, we're going to go back to our development projects one last time and look at them in the context of things like net present value, discounted cash flow valuation, which is the most important method by far, and a few other things. After that, we'll know everything we need to know about general finance, and we're just going to keep applying it for the rest of the semester to various aspects of real estate finance. So, for example, we will learn about cash flow producing property purchasing, upgrade, management, and sell or recycle. We will learn about valuation of large real estate entities, things like REITs that have a whole portfolio of cash flow producing properties that they're managing. Then we're going to spend some time on public sector participation in real estate finance. This is going to be extremely important, as you can imagine, in the next few years, given that our president and both the Republican and Democratic sides of our Congress agree that our infrastructure needs upgrading, expansion, and replacement. And I think just about everybody agrees we can't pay for all of that with just taxes. So public sector participation is going to be important, especially by the time you're graduating. And then finally, we will end the semester with financing of sustainable or green real estate projects, and we'll compare those to traditional projects. Okay, so that's sort of where we are now, where we've been, and where we're going. So with that, let's move on to Treasury security. So the U.S. Treasury Department issues debt securities of largely two types. Notes have by definition, less than a year to maturity, and bonds have a year or two to maturity. Currently, the longest dated Treasury bonds are 30-year to maturity bond contracts. So all of these are collectively called Treasuries. And in case you don't know why Treasuries are issued, it's to make up the difference between the revenues of the federal government, which all comes in from tax, okay, essentially all, some fees, but mostly tax, and expenditures, which are programs that the government has committed to paying for and execute. Treasury market is huge in size. There's about 11 trillion in U.S. government treasury notes and bonds outstanding right now, meaning the contracts are outstanding. And the total worldwide bond market is about 80 trillion. So we have significantly more than 10% of that market. Another way to think about the US Treasury market is that it represents 60% of annual US GDP. So, in other words, if we decided to pay off all of our Treasury debt, it would take 60% of what the entire US produces in gross domestic product in a year to pay that down. That may seem like a lot, which it is, but it could be a lot worse. If you look at Japan, Japan's sovereign debt, their equivalent of treasuries at their national level, represents 180% of their GDP, meaning it would take, if they threw every nickel of their GDP at paying down their sovereign debt, it would take them 1.8 years. That's pretty serious, especially because their demographics are bad. Their population is shrinking and their population is aging. Doesn't bode well for paying all that back. The also worthy of note is that in 2012, latest year for which we have data on right now, with a good count, 1.1 trillion bonds and notes were issued, and that should be what, just about the size of the federal deficit for that year, because again, these things are issued to make up the difference between what comes in taxes and what the federal government is committed to paying, and that's the deficit. The average trading volume of treasuries is about 800 billion, and that's 10 times as much as the entire US stock market. So that's an enormous, enormous amount of trading in treasuries that happens every day. So with all this in our pocket, it's fair to say, and is said because it's true, that the US Treasury market is the most liquid, transparent securities market in the world, and that will become important for a number of reasons as we go on. Okay, so let's just make sure we're all on the same page with what Treasury securities are. Treasury securities, notes or bonds, are a contractual framework, okay, and we need to think about their cash flows and their tradability. So in terms of cash flow, as you can see on the cash flow diagram, the way it works is just like any other bond contract, the Treasury gets some money now, it sells that contract, gets some money now in return for performing per the contract specifications, which say, for example, with the 3-year bond that I've got shown in the cash flow diagram, the Treasury will get 100 million in return for paying 10 million in interest for the next 3 years to whoever is holding those bonds, and then at the end of the 3 years paying back that $100 million. Okay, this is just like bond contracts that we've looked at before, and even loan contracts. Except the reason this is more like bond contracts than loan contracts is Treasury bonds, just like all the other bond contracts we've looked at, are transferable. Okay, so they can be bought and sold after issuance, which we've seen happens a lot. And just like with any other bond or note contract, the Treasury pays whoever is holding the bond. They don't care who they sold it to in the first place because it's a transferable contract. Whoever is holding the bond, they have to execute per the contract terms. Okay. Treasury securities are considered risk-free in quotes, and I've got risk-free in quotes because it's not truly that they are risk-free. The meaning of risk-free for Treasury securities is that there's virtually no probability that the U.S. Treasury Department will default. There is a non-zero probability, but it's fairly small. Um, so investors believe they will pretty definitely be paid back in full and on time. So what this means is that investors buy treasuries when they're scared of or worried about the failure of other investments like stocks and high yield bonds and even real estate, things like that. And that's why we say that there is a flight to treasuries and market panics. When the market is starting to panic, people sell their stocks and they buy treasuries because the treasuries are so safe. And this is one of the reasons that we call the dollar the world's primary reserve currency, because worldwide investors, institutional and retail, behave this way. So if they are somewhere in Europe to buy treasuries, they've got to exchange their euros for dollars. And so dollars are the preeminent currency around the world. That's why it's called the preeminent reserve currency. Okay, just because treasuries are called riskless in quotes does not mean that they have no risk. Okay, all it means is that there's a very low probability that the US federal government is going to default on those bonds and notes. But there are risks to treasuries, which include inflation, interest rate, and again, that default risk, which is very, very small. Um, these risks are clearly not independent. Okay, inflation risk is clearly going to be tied to interest rate risk. Okay, um, and also the interest rate risk is tied to the perception of default risk, etc. Um, all of these risks also increase with time to maturity, which should make sense to you intuitively, right? The longer time frame for which we have a contract going out into the future, the higher the probability that something could go wrong along the way. And that's going to be true throughout finance, real estate development finance, cash flow producing properties, et cetera, et cetera. The longer it takes a development to happen, the higher the risk that something will go wrong. There will be market downturn, et cetera. Um, so with all of this in mind about treasuries, we're going to call treasuries risk-free securities despite their very real risks. And so when we're using treasury interest rates or discount rates in equations, we're going to mark them as R risk-free, or for short here, RRF, okay? And we call them risk-free rates. So let me just give you a couple quick examples highlighting the fact that there is indeed treasury bond risk. Let's say that you buy a 10-year zero coupon treasury bond at issuance. Zero coupon again means you're going to get nothing for 10 years, then you're going to get a pile of money at the end of the 10 years, okay? And here's how this particular one works. The face value, which is what the treasury is going to give you at the end of 10 years, assuming you haven't traded the bond, is say $100 million. And right now, let's say the inflation rate is 2%, which we will start calling out in equations as RINF, short for R inflation. And let's say right now investors are sort of medium scared, medium concerned about riskier stock investments. Remember, Treasury is definitely, there is some risk, but they're considered to be the least risky of all investments in the universe. Um, So investors are medium scared. Trump new president, he might go off do something half-cocked, but not super scared. We're not in a crisis right now. Okay. So given all that, the Treasury auctions off these contracts, these bonds in the marketplace. And what they find when they do this auction is that investors demand a risk-free rate for this bond of 8%. So the Treasury, of course, doesn't set the risk-free rate. The marketplace sets the risk-free rate. How did that RRF of the marketplace got found? Well, there was the Treasury auction, okay, and the 8% includes 2% for inflation risk and 6% for other risks, including interest rate risk and default risk. The inflation rate risk we have measured from the consumer price index or the GDP deflator. So we can put a number on that. A little bit harder to get numbers on the interest rate and default components of the remaining 6%. Okay, so if investors feel like they need a total 8% risk-free interest rate on this 10-year zero coupon treasury bond at auction, how much are they going to pay for it? Very, very simple. We know how to do this. We just use the present value, future value formula, and we solve it for the present value. We know the future value is going to be 100 million. We know that investors are demanding at auction an interest rate of 8% for this. So we just say the present value is equal to the future value divided by 1 plus 8% raised to the 10-year contract, work that out. Investors are going to pay 46.3 million for all these bonds. Okay, so you buy some of these bonds. Let's say you buy one for 100 that has 100 face value. You pay 46.30 for it, and for some reason the next day you decide you just have to sell the bond. And let's consider two scenarios. Scenario one is that inflation expectations overnight have risen to 6%. It could happen if Saudi Arabia, for example, overnight said, we're going to stop producing oil until the price goes up to 150 a barrel, and simultaneously Venezuela just admitted that all its production facilities are useless and it's going to shut down for 2 years to rejuvenate them all. That would shoot inflation expectations up wildly, certainly something like from 2% to 6%. So it could happen. So now investors for the bond that you have, they're going to demand, nothing else has changed here. So for the default risk and the interest rate risk, we've still got the 6% they're going to demand. But now, instead of 2% for inflation risk, they're demanding 6%. So they're going to demand a 12% total R for this bond, okay, or RRF for this bond, okay? So what's the price going to be paid by the person who buys this bond from you one day after you bought it? Same deal as before. We use the PV-FV formula. Okay, they're going to get 100 at the end of the 10-year contract, but now instead of 1 plus 8% to the 10, we have 1 plus 12% to the 10. So they're going to pay you $32.20 for this bond. So you lost 14.1% overnight on this bond. Okay, so that's not good. So here's another case that could happen. Overnight, let's say world peace is declared, and most investors lose their fear of riskier equity investments. In this case, there's going to be an inverse to the flight to quality. If there's not much risk in the world, everyone's going to go to equities, which potentially will give them a better return than treasuries. So demand for treasuries is going to decrease. The price of treasuries, therefore, is going to go down, just supply demand 101. And the interest rate for treasuries is therefore going to go up just by the math here. Future value equals PV times 1 plus R to the T. Okay. So the FV comes from the contract. So if the PV goes down, the R has to go up. So you once again could lose 14 per bond. Okay, so it really is the truth, the whole truth, and nothing but the truth that treasuries do have risk, as we've seen in these two examples. Okay, next up, treasury yield curve. In general, as I've said before, any project's risk increases with the time of the project, with its duration. Okay, so for treasuries, what does that mean? The longer time till maturity means that there's an increased possibility of a debilitating interest rate move, deflation, or default. Those are the three risks for treasuries again. So the longer the time frame, the more possibility is one of those things could go against you. Okay. So this would manifest itself if you needed to sell the bond, as in the other two examples. The bond value could simply not keep up with inflation if inflation actually goes up during this period. And the default would mean a bond restructuring. Very small probability of that in the US, but this actually happened in Greece. So it does happen to some sovereigns, and it is a low probability possibility, but it is a real possibility. Okay, so therefore, for all these reasons, investors should demand higher yields, higher RRFs for longer dated treasuries. This is found to be true empirically, as recorded in the term structure of Treasury interest rates and graphically represented in the Treasury yield curve. So let's look at the Treasury yield curve and see how this works. So I've got a Treasury yield curve here. What we have on the x-axis is time to maturity of the Treasury bond contract, and on the y-axis I have yield. So this is going to be the data that's plotted here is going to be for a set of zero coupon treasury bonds. So one, for example, matures in 3 months, one in 6 months, one in 2 years, one in 5 years, one in 10 years, one in 30 years. And you can see that the yield for the 3-month contract is very, very low, about 0.0 5%, and for the 2-year contract, it's about 0.5%, and et cetera, et cetera. So the interest rate, the R demanded by Treasury investors, is higher the longer the time until the contract expires, until the bond matures. So that's an issue. Okay, another thing to note here about this is that the Treasury yield curve here is fluid in time. In other words, what I mean by that is that the the curve, the expectations for risk of inflation, interest rates, default are going to change over time. So the whole yield curve is going to shift over time. So I've got two different yield curves shown here to illustrate that. Okay, so with this in mind, the role of treasuries is very important in measuring the risk of any financial project, including real estate financial projects. It's actually foundational to all of our risk models, so it's important that we understand it, okay? The key characteristics, why is it foundational? Well, Treasury securities are universally considered safest investments worldwide. The risks are few. We have those 4 risks, right? We have interest rate, inflation, we have default, low probability, and time, okay? But they're pretty well understood. And the Treasury market, as we've seen, is the biggest, most liquid, transparent securities market around. Okay, so for all those reasons, Treasuries are an important part of any financial risk model. And what are our risk models going to include overall? That's going to be the subject of our next chapter, which we're going to have to cover before we jump back to more DCF valuation and looking at NPV in particular. For any project, real estate, non-real estate, anything in finance, we have three types of risk plus time risk. We have our risk-free risk, okay, which we talked about, our industry or market risk, and our project-specific risk. So in detail, risk-free risk, as we know, includes inflation, interest rates, and default, and we measure that risk-free risk. Now that sounds like an oxymoron, but it's really true. We say risk-free risk. We measure that by Treasury bonds. Industry or market risk means we're looking at potential industry-wide disruptions. You can think of this as a recession in a certain industry or a disruption in an industry that is causing legacy players to go bankrupt, something like that. Also, macroeconomic events, a full-blown recession, a stock market crash, something like that. We're going to measure this by looking at a diversified portfolio of industry-wide or market-wide projects, and we'll get to the hows and whys of that in the next chapter. The third type of risk, as I said, is project-specific, and that is where we look at this project's unique issues, which could be maybe this is a great deal, a great development deal, but we have a bad manager managing the development. What if we have an entrepreneurial company we're looking at, it has only 3 contracts and it loses one of them? That type of thing. So these are risks that are specific to just this project. And I think of this in short as bad manager risk, which is really not quite fair because it could be other things, but nonetheless, I sort of think of it that way as a shorthand. How are we going to measure this? No way around it except a fundamental analysis of this project, and we'll learn how to do that in the next several chapters. We'll have to do things like saying if we have a company with only 4 contracts, what's the probability they're going to lose one, what's the probability they're going to lose 2, etc., etc. Okay, and as I've noted before, every project in finance has time value risk, okay? The longer the project's duration, the more the risk we have. And I love this graph. This is standing at time t equals 0, where we are now, and these are projections. Well, it's actually somewhere near the end of 2008, but that's okay. Let's pretend in time we're going back to somewhere near the end of 2008. So we know historically exactly what real GDP was doing, and in the future we're not sure, and the further out we get in the future, the less sure we are here. And what's represented here by this, it's called a fan chart, is standard deviations around our expected value. So the farther we go out, the more standard deviations we go out, the less certainty we have around what our best guess is. Okay. So the next thing in this chapter is an appendix on sovereign capital raising and risk. I am not going to cover this, and you are not responsible for that. However, it's kind of interesting. So if you care deeply about capital markets in general, you're thinking about going into real estate finance, you might want to take a look at this and the accompanying text in the Introduction to Business Finance textbook. And I think with that, I am once again going to say sayonara.